and welcome. My name is Taylor Bree Casey. I'm the Communications Manager at Munro Partners. Firstly, thank you for braving Melbourne winter to get here today. We are so thrilled to see so many of you and have so many of our investors in the room today. Today is for you. We felt like we wanted to make sure that we could give you an opportunity to hear the views of our investment team and ask questions that you may not get a chance to ask them normally. So we spoke at great lengths to work out what kind of information to give you today. And so we have a star-studded lineup for you. And I'll just quickly run through the agenda of what we're going to be speaking through today. So first and foremost, a man that needs no introduction, our CIO, Nick Griffin, is going to be taking us through a bit of a business update and about Monroe, a market update. There's been plenty going on in the world, and also a few views on AI as well. And then we're going to have our portfolio managers, Kieran Moore, James Fasindis and Chow Ma, going through a current positioning panel that is going to be emceed by our brilliant client portfolio manager, Steve Fletcher. And then, of course, after all that, if you have more questions, we want to make sure that they get answered. And so myself and my colleague, Bianca Mercury, will be walking around with some microphones so that you have a chance to ask the questions that you need answered. So to start us all off, before we get into all of that, we have a very short video for you, and then Nick will get up and do his presentation.
I mean, it sounds like a cliche, but the biggest learning is our process really works.
Over time, what we've found in equity markets is that basically the market is a game of lots and lots of losers and very few key winners.
We tend to invest in the leaders in each of those industries, so that company has a very strong read on what's happening in their end market, what's happening with their customers, what's happening with their backlogs, and also have a very strong industry position relative to peers.
And what gives us the conviction, the excitement for the future, as much as we're happy for the stocks that we pick, there are so many stocks that we've missed. There are still so many stocks that's really coming our way that really give us a lot of optimism on the strong earnings growth to continue.
Can you tell us a bit about Munro Partners?
Munro Partners is set up to be your global growth equity manager. Global equities, growth.
And what are the products that we offer?
We offer 4 products: absolute return, long only, climate, and SMID.
What is the team's investment philosophy?
So look, we run on a fairly simple philosophy that companies that make more money every year, their share prices generally go up. So what we look for is companies who can grow earnings structurally over a long period of time, and then their share prices grow structurally over a long period of time.
And our investment process has 4 distinct steps. What are they?
Yeah, so if you're looking for companies whose earnings go up every year, don't bother looking at cyclical companies, look at structurally growing companies. We have shrunk our universe to just 1,000 companies that we think can structurally grow over a long period of time. Within that, you need to find the highest quality companies, and so we have 6 great qualities for a great growth company, but you can't buy them at any price. You've got to do the maths, so we do the bottom-up maths on top of that to prove that they can double within the next 5 years. And the last part of the process is simply having a process for eradicating the mistakes that you're inevitably going to make.
Can you explain what an area of interest is?
So within our structural growth universe, the companies need to be structurally growing, so they have to be taking share from something else. And so these areas of interest are areas of what we see as structural growth.
And what would you say is Munro's edge?
Our edge is our process enables us to really find that simple solution of finding the few winners. Equity markets are a game of very few winners and lots of losers. Your job is to find the few winners. Our process is only looking for the few winners. Hence, we've become quite good at doing it over a very, very long period of time.
And I think we've got a pretty fantastic investment team. Can you tell me about them?
Look, the investment team is driven by the partnership. We own and control 75% of our business. We give the equity to our staff while they work at Monroe, and when they leave, they have to give it back to the next person. That allows us to attract and retain really good people who are all working towards one goal, which is the profit share of Monroe. The profit share of Monroe is aligned with the results that our clients achieve. And so the investment team across all our strategies works across all our strategies, working towards finding these few winners to ultimately give good returns to our clients to get good returns for our business. That is our edge, that is our team, and there's no reason why we can't continue to attract and retain really good people to work at Monroe to help us do this even better in the future. Claps. Thanks very much. Hey, everyone, thanks very much for coming today. I just want to repeat Taylor's sentiment that we really wanted to do this. It's been nearly 10 years since Monroe was formed. We'll talk about that in a second. We've actually never done a direct investment briefing before. We work in advisor channels and institutional channels, but you are very important to us as well, particularly with our ETFs. And we thought today was, this is something we've wanted to do for a long time. And if today goes well, we'll keep doing it every year. So we'd love your feedback as to how we can do it better. So who knows what a Monroe is, just out of interest? Anyone in the room? There's got to be a couple. They've all seen the videos. There's one. Basically, my friends are putting their hands up. Okay, so Munros, if you don't know, are the names of mountains in Scotland, okay? So if you go to Scotland, any mountain over 3,000 feet is called a Munro. There's 282 of them. Your job is to go climb them all. I used to live and work a lot of my career in Edinburgh. And when I came back to Australia in 2016, we wanted to set up a funds management business, just like the great fund managers of Scotland. If you've ever been to Edinburgh, and I'm sure lots of you have, there's some great fund managers there. Ballygifford, Walter Scott, Friends Ivory and Syme back in the day, etc. They've got this really long history of basically sitting in a faraway place and taking long-term views of the world. And when I came back to Australia in 2015, that was what we wanted to do. We wanted to sit in a faraway place and take long-term views of the world. We sit right here in Collins Street, just over the road, and we take very long-term views of the world. And so what we want to be is we just want to be your global growth investor. That's always been our mission. So put simply, we do global equities only. Please don't ask me any questions about Australia. I don't know. I don't know what happened in the budget. I mean, I sort of know, but I don't really. We don't look closely at that. We basically look at global equities and we do look at growth. So we're permanently a big glass half full, okay? So we're permanently going to be looking at what the opportunities are in the world, not necessarily worrying about the risk. We definitely worry about the risk, but obviously being more opportunistic, if that makes sense. Business, as I said, was established in July 16. It is a partnership. So as I said in that video, we own and control the business. We share the equity amongst the staff like a law firm or an accounting firm. And when you leave, you have to give it back to the next person. And what that means is we're able to attract and retain really good people. You're going to meet a lot of them today, but there's also a lot in the audience that are helping you every day build the products that we put in the marketplace. We have just actually under $9 billion in assets under management, so this has gone up a bit since last month. We have 34 staff. We have an office here in Melbourne and a satellite office in Canada. That's who we are and what we do. This is our journey of funds management. So just to give you an idea, it's actually quite hard to start a funds management business, having done it. We started with just $20 million back here. And I can actually see people in the room who helped start us. They helped put money in us very early, and that's why, as I said at the start, we want to support and look after our direct investors. That FUM grew over time. We started with just the absolute return fund, which a lot of you guys would know as MATE on the Australian Stock Exchange, MAET. But it is important to flag, we do run long-only products. We have launched the climate product that James looks after that you'll see today. And then we also have a mid-cap product that Charles looks after. And so obviously this has grown dramatically. And over time, more and more people have invested in our long-only products alongside our absolute return product and pushing $9 billion today. And as I said, the real key to this the whole success is that partnership model, that ability to attract and retain really good people. It clearly can't do this by yourself. These are the 4 products we run. 3 of them are available as ETFs, which I'm sure some of you are invested in or why you're here today. The first, all of them are trying to get you more than 10% per annum returns through the cycle. The first is Munro Global Growth Fund. That's the absolute return fund. That's giving you more than 10% per annum, but with downside protection. So it has downside protection tools through the cycle that are ultimately designed to smooth the ride for you. Our other products are long-only products. So they're fully invested all the time, and they're trying to beat the market, so to speak. The first is the Munro Concentrated Global Growth Fund, which is actually just the same stocks as the Absolute Return Fund, so exactly the same long stocks, or the actually same stocks were invested just without the downside protection. So slightly higher risk, slightly higher return. And then you have the Climate Fund and the SMID Fund that are again being more specific in, say, satellite areas like small caps or the enablers of decarbonisation. And again, they're slightly higher risk, slightly higher return. And so when you look at the performance of our products, That's basically what they're doing. And so we have a saying here at Monroe that we talk about a lot. It's one of our cultural values, is the products could basically do what it says on the tin. It's very important to us that the products do what they say on the tin. The absolute return fund is giving you 13% per annum for nearly 10 years now, after all fees and expenses, with lower volatility than the market. And our long-only products had launched a bit later, but they're all outperforming their respective indices over that time period. And the guys will talk a bit more about this later on. The last thing I just want to quickly touch on is our values. We obviously talked about the partnership. We talked about being the global growth manager. The key thing that we talk about to new employees that come along in terms of cultural values is that we just need to turn over a lot of stones. Basically what we do, we're looking around the world, our job is to turn over a lot of stones. If you don't turn over a lot of stones, you're not going to find some of the things we're going to talk about today. Our ownership structure basically forces everyone to act like an owner because they actually are owners. And as I said at the bottom, hopefully our products continue to do what it says on the tin. This is the investment team that we've amalgamated over at 80 Collins Street. And we'll continue to add to this over time. You'll continue to see more and more shiny faces on your videos that Taylor so lovingly prepares for you. Last thing I just want to really quickly talk about before I dive into the market and the outlook, what you're actually here for, is just to talk about distributions. We get a lot of phone calls sort of on July the 1st because our funds do pay distributions. So if those of you who are invested in the ETFs, be it MAET or MCCL or MCGG, the ones I showed you before, it's important to understand these products are unit trusts. They're unit trusts that don't pay tax, okay? They don't pay tax, they're tax-free instruments. But every year they need to pay out their realised gains and their dividend income in a distribution. You should think of that distribution a bit like a dividend, no different to a dividend that a share would play. And we pay that out, and that falls into your tax environment. And whatever your tax environment is what you have to pay tax on. And that might be in superannuation, you might be a charity, or you might be a top marginal tax rate player. What I'm showing you here is the distributions over the years, and depending on how we've performed, the distribution can move around, if that makes sense. So some years it's 8%. In 2022, when we'd had a difficult year, it's 0, 23 it's 0, then it's 2. And then last year we had a really big one. And the reason why we had a big one last year was because we had a very strong period of performance, as you can see from the bottom to the top. And then we'd realised a lot of our gains before Liberation Day. We wanted to sell down before Liberation Day and end up with a big distribution. What you can see is the share price goes down, but the purple line on the top is actually your total return. Your total return is actually very good. You just had an 18% distribution. That distribution arrives in your bank account roughly 3 weeks after the stock goes X. And I can assure you it does, and if it doesn't, please call our registry provider, but I'm pretty sure it will. And so from that point of view, as we go forward, just to be clear, we are coming up to 30 June. We have published what the indicative distributions are going to be. And I want to be clear that these are estimates, okay? So these are estimates as at the end of April. You will get a letter in the mail coming up to these distributions, and you can choose to reinvest your distributions. I personally reinvest my distributions. Ultimately, that's up to you and what you want to do. But these are the indicative distributions that are coming up. You will get informed about this if you want to move to electing to reinvesting. And yeah, hopefully that explains it, and we won't get as many phone calls as we got last year on the 2nd of July. But that's effectively the distribution outlook, and happy to take questions on that later. Okay, this is what you came for. It is our annual meeting. We want to give you our view on the markets, and then we want to give you our view on where we're going to invest, what's going on. And so what I'm going to quickly run through here is our market outlook, a bit of an outlook on AI, and then the team's going to jump up and show you where we're positioned. Some of you will hopefully recognise this. This appeared in our annual letter. So we write an annual letter every year. It got published in the first week of January, I think. These are our 4 big predictions for the year. And so far, thankfully, doesn't always work out this way. So far at the end of May, we're still standing by these predictions. They're slow, they are working out. And so from our point of view, we said in January, and we still think this today, is that the bull market will enter its 4th year, okay? So we are in a bull market in global equities, particularly in the US, okay? So 2022 was a bear market. S&P fell 20%. NASDAQ fell like 33%. Lots of stocks fell a lot more than that. And at the start of 23, we started the next bull market. 23 and 24 were the best years of returns, and I showed you before, we had very strong returns through those periods. Last year, 25 was a double-digit year, and we think this year is probably going to be another double-digit year. We think you're still going to get comfortably double-digit returns out of markets. Ultimately, most bull markets last somewhere between 5 and 10 years. We'll wait and see how long this one lasts, but we are only in year 4. The bull market is being driven by the AI data center build-out, okay? So it's not a surprise that the bull market started roughly the same time as we discovered ChatGPT. And from that point of view, the AI build-out is basically what's driving this market, and we'll talk a lot about this today. You can't believe in the bull market and not believe in the AI build-out. They are connected, and we'll show you a lot about this today. The AI build-out is so big, we're spending so much money here that it's actually broadening out. So the money is flowing through all these different parts of the economy. It's not just semiconductors, it goes down to power companies, it goes to construction companies. You'll even see it in BHP's earnings. The reality is this is a big build-out cycle, a lot like the super cycle, and it's going to broaden out into lots of these different areas. You're seeing it in places like Korea and Taiwan, et cetera, et cetera. And the last thing you need to be really clear on is that disruption here is going to accelerate, okay? So as disruption accelerates, the winners and losers are bifurcating faster. We said that in January, and what you've seen so far this year is this huge bifurcation in market. I'm sure people are going to ask me about software. We don't own any software stocks. We haven't owned any all year. We did own them last year. We sold them last year. But you're going to keep seeing these disruption threats as AI gets better. And it's something that we're very aware of, and it's important to stay disciplined. So let me just quickly talk about geopolitics, because we're going to get lots of questions. Surprisingly, we think this is actually a sideshow. This is a sideshow compared to AI. It is important to, I know there's a lot going on geopolitically at the moment. We've obviously had an Iran conflict. We had Liberation Day last year. But the reality is whether you love Donald Trump or you hate Donald Trump, he is actually net positive equity markets. And he's net positive equity markets because he's basically embracing his national champions to help the US grow its way out of its debt problem. And by doing that, he actually forces every other country in the world to embrace his national champions to grow their way out of the debt problem. And so you see this in Germany, where they're obviously having to invest heavily in defense. You even see this in places like China, where they've had to re-embrace their tech sector to ultimately catch up in the AI race. And so I know there's a lot of bad things happening here, but they're all actually slightly net positive. There are good days and bad days, but ultimately we think this is net positive. I said exactly the same thing last year. I'm sure you'll take me up at the Q&A. The bigger deal that's happening now is actually AI. This is what's really driving markets right now. And this is what you need to get your head around. And so I'm going to spend about 5-10 minutes just trying to explain this and why we think this is so important. And so what we're going through right now is a platform shift. So I'm actually old enough to be around for the last platform shift. And I hope I'm around for long enough for the next platform shift, okay? So what do I mean by a platform shift, okay? So some of you, hopefully, will also remember the days you used to get on a train in Melbourne and everyone read the newspaper, okay? Everyone bought the paper, they all sat on the train and they read the newspaper. And they all read the newspaper because that is where they got the information that they needed in the world. All the data in the world was effectively amalgamated on paper. Whether your share prices were there, the news of the day was there, where you wanted to go on holidays was there, the social news was there, et cetera, et cetera. What house you wanted to buy was there, if that makes sense. So you had to buy the paper to get everything. And we went through a platform shift. We effectively went through a digitalization shift, firstly to PC, but then much more so when we got to mobile. And so when we got to mobile, all the winners here ended up on here. You changed the surface of which you interacted with technology. And so instead you got your news out of Facebook or Google, you got your stock prices out of whoever managed to get the app on there. And ultimately you use this product. And so Meta, Google, Netflix, Uber, Spotify, all appeared out of this big platform shift, okay? And these companies didn't die. They just went through a really, really tough period of trying to survive this big platform shift because you changed the surface of which you interacted with technology, okay? We're now going through a platform shift. You're going to change the surface of which you interact with technology. A lot of you have already started doing this. You started using AI. You're using it to solve a question. It's getting better at answering the question. And now we're moving to agentic AI where the computers can actually solve problems for you. So why would you go searching around all these different apps when the computer can actually solve the problem for you? And that's where we're getting to. And so these companies aren't going to die. They've just lost their surface area. They've lost their interaction with you because you're now going to interact with an agent. And that's going to change the economics dramatically for the incumbents. And obviously, it's going to create a whole new bunch of winners. Exactly the same as last time. We got a whole new bunch of winners. We're going to change the platform, get a whole new bunch of winners. And so what's actually happening here is what we do know already. We don't really know what all the big applications are going to be. We sort of know they're probably going to be Anthropic and OpenAI. But as you can see from software stocks, it's very hard to work out who the winners and losers are in the applications. But what we do know is that AI is going to use a lot of compute. Okay? We know that this is all very compute intensive. And this is where we start talking about tokens. So when ChatGPT first came along, you would ask it a question and it would sort of get it 80% right. And that would use one token, okay? That would use one token of compute. That one token of compute was roughly 8 times as much compute as you needed for a search query, okay? But then they made AI better. They made reasoning models, okay? So now when you ask AI a question, it asks itself the same question over and over again. It asks it like 1,000 times to make the answer better and better and better. And that ends up using 100 tokens, if that makes sense. And so it just got better and better and better. And so AI got better, not by the models getting better, just by the models asking themselves the same question over and over again. And now we've moved to agentic AI. So now you've got agents that are off solving problems for you, talking to other agents. And so, for instance, at our office, we can set agents off to build Excel models for us. We can set agents off to compare what the result was this morning versus our investment thesis and tell if it's on track without us having to read everything. And these agents are using literally thousands of tokens and then thousands and thousands of tokens with each other. And so compute is going effectively exponential and token use is going exponential. And so these are the big data points that started appearing sort of November, December last year. We effectively got this takeoff in agentic AI. So these are the amount of tokens that we're using in the world, i.e. the amount of compute that we're using. And this is the average revenue run rate of Anthropic and OpenAI. And so I'll just talk about Anthropic as one. So at the end of last year, their annual revenue for the year, annual revenue run rate was $9 billion. By the end of March, that had got to $30 billion, okay? So they'd added 21 billion of average revenue run rate in 3 months. And by the end of April, it was $45 billion, okay? So these tokens are effectively going parabolic. The revenue that people are prepared to pay for these tokens is going parabolic. Why? Because everyone's using agentic AI. Just to put that in perspective, $45 billion, Anthropic is adding more money per month than every other software company on the planet combined by a factor of 2. Okay? It's adding more revenue per month than all the Mag 7 combined. So we have never seen anything grow at this scale and at this size this quickly. And so what that means is everyone's adopting AI like very quickly. So the promise of AI is becoming true. People are finding users for these tokens. And we'd argue this is just getting started. And the reason why it's just getting started is because AI, unlike the previous platform shift I showed you, which was effectively mainly consumer, AI actually affects every industry on the planet. And so rather than just us using Claude or you using ChatGPT, what's actually going to happen here is you're going to use these agents in things like robotics. Robots are going to be able to think for themselves and do things. An autonomous car. Who's been in an autonomous car in the States yet? There are lots of us, okay? So it works, right? An autonomous car is effectively an agent. It's an AI agent. It's basically using all this compute to solve the problem of getting the car around the city. We're seeing digital twins being built. So you can build things much quicker because you don't make mistakes within a digital twin because you can build a perfect digital twin. And the agent can point out the mistakes before you make it. E-commerce and travel will be transformed dramatically out of this because the agent can book the holiday for you. And lastly, we're going to have drug discovery. So effectively, these AI agents, these AI workloads can be used across every industry in the planet, which basically means that token slide I just showed you is probably just getting going. Anthropic's revenues and OpenAI's revenues are going to go well through $100 billion, well through $200 billion per annum. And when they do finally IPO, they're probably going to be some of the biggest companies in the world. And so from our point of view, what do we want to do? We want to invest in tokens, right? It's pretty simple. If tokens is what's going to grow here, and OpenAI and Anthropic are basically selling you your tokens, then the simple way to invest in here is to buy tokens. So how do you invest in tokens? This is how you invest in tokens. This is what we've been doing now for 3 years. The reality is AI is a 5-layered cake, okay? It's really simple. Effectively, you have thousands of applications at the top across all those different industries that are effectively wrapping these large language models to solve problems. And what we now know is solving them at a parabolic rate. As they solve those problems, we're going to need a lot more compute. Because these agents, if you think about it, are not just using 1,000 times more token, they're all talking to each other. Like we have 12 in our office alone talking to each other. So they're using like 150,000 or 1.5 million times more compute. We just need a bigger boat here. We need a lot more compute. And so as these models use it, it all goes to the cloud. The cloud needs to basically build more data centers, dramatically more data centers. They spend all of their money buying more semiconductors and networking equipment because that's ultimately what goes inside a data center. And most importantly, the key component of a token is electricity, is power. You need power. Whoever has the most power here wins because you need the power to drive the semis. The semis basically run the cloud runs the AI, and the AI runs the applications. And so from our point of view, you really want to be invested in the shovels in this boom. And so what hopefully a lot of you have been seeing in the last 3 years, our funds have been performing quite well. And the funds have been performing quite well is because we've ultimately worked this out. The last place you want to be is at the top in the applications. Because the applications are what's getting disrupted. This is what's happening to the software companies. This is what's happening to the information service companies. This is what's happening to Xero. This is what's happening to realestate.com. They're all getting caught by these new AI use cases that are ultimately disrupting them. And down the bottom here, this is where all the earnings growth is. This is where the earnings growth is because this is where all the money is being spent. To show this a slightly different way, this is the CapEx from the hyperscalers, okay? The hyperscalers we call the big cloud operators being Google, Microsoft, Meta, Amazon, and Oracle. So collectively this year alone, they're going to spend roughly $650 billion on data centers. If we add up everyone else, we're going to get to $1 trillion this year on data centers. To put that in perspective, 5 years ago, they spent $30 billion. So that's gone up roughly 33x in the last 5 years. All of that money, as I showed you before, flows to all the shovels in the boom. It flows to the shovels in the boom. In the same way, in the super cycle here in Australia, all the money looking for iron ore flowed to the shovels in that boom. The shovels in the AI boom are things like memory. This is the free cash flow of these companies. These are the beneficiaries. So just follow the money. Where's this money being spent? That's going to equal earnings growth. You're going to get great earnings growth out of these memory companies. We're obviously already seen that. You'll get great earnings growth out of NVIDIA and AMD and Broadcom. We've seen that. It should continue. You'll get great earnings growth out of the foundries, so the TSMCs and the semiconductor equipment makers that make these chips. And then probably a little bit left field where we've been making a lot of money more recently because it hasn't been discovered yet. You'll make a lot of money out of the power companies, the people that provide the power, that provide the switchgear, that provide the transformers, etc. You'll make a lot of money out of the networking. Chow will talk about this a bit later, but that's basically the cords that connect these data centers. And you'll make a lot of money out of the EPC companies that are going to build it because ultimately you're just following the money. You're following the CapEx from one side to the other. And everything I just told you is this CapEx is actually just getting started because we're now actually using this stuff at scale. And so what you're seeing in the market now is the whole market realizing that the AI CapEx boom isn't a bubble. It's actually a boom that actually just started, and it's probably going to go for the next 5 to 10 years. And so from that point of view, we think we're roughly 3 years into something that's going to run for 10 years. It will eventually, most booms do end in a bust. The super cycle here in Australia did as well. But if you remember, it went a lot longer than everyone thinks. And in this case, you are much closer to the start than the end because we ultimately have no idea how far that token growth is going to go, but it does look like it's just started. Okay, so this is your iron ore and the opportunity. Everyone here in Australia knows how to do this. BHP and Rio are getting all the iron ore out of the ground. All the people who supply them are the winners. This is the iron ore. It's a data center. We're going to build literally hundreds of these things around the world. They're going to get bigger and bigger and bigger to process all these tokens. And these are the companies that are going to be supplying them. The team's going to talk a lot about this today. Last thing, just to bring this back to the market, is what this actually means is you just get this, you're getting this amazing earnings growth out of the market. So I know the S&P 500 is going up a lot while there's a war in Iran, while Donald Trump is around doing all sorts of random things. And it's because the earnings growth is actually accelerating. The earnings growth is accelerating because all that money is flowing through the economy, if that makes sense. And so we see it in, obviously, Google and TSMC, but you also see it in Morgan Stanley. Like you see it in investment banks because they have to fund this build out. It's like you're building the office infrastructure of the planet, like really quickly, as we fund this build out of all of these data centers. So you'll see it in banking, you'll see it in copper, you'll see it in resources, you'll see it in energy companies as well. And on top of that, lastly, this is my last slide, you'll see it in the whole market. So what I'm showing you here is the earnings of the S&P 500. Okay, this is the S&P 500. And if you look at the earnings blended forward, it's going parabolic as well. It's basically following the token growth up. And the reason why is because all this money is being spent to create these tokens. And the S&P 500, I'm showing you the PE multiple on the right there. The S&P 500 today is cheaper than it was 6 months ago because the earnings have gone up so much. And so the simple conclusion of everything I'm trying to say here is basically we are going through a big platform shift. That platform shift is very CapEx intensive, incredibly CapEx intensive. The new technology we have has an input cost. That input cost is a token. We want to invest in the companies that basically make up that token, i.e. electricity, semis, cloud, and all the pieces in between. And then that token will be sold on to a business like ours who will use it to create better outcomes, or a business like yours that will use it to create better outcomes. Token growth will explode, is exploding, will continue to explode, and that ultimately drives the earnings of all these companies, which is actually driving the earnings of the whole market. And so you're actually really just at the start of something that hopefully we think will go for a number of years. And so from our point of view, we remain bullish markets. In fact, we're more bullish than we were at the start of the year because a lot of this stuff has really just happened in the last 6 months. And personally, sitting at the start of probably one of the most exciting periods I'm hopefully going to go through because we're going through a platform shift. The last time this happened was when Facebook and Google IPO'd. And that was a lot of fun. I hope this is going to be a lot of fun. So that's the end of my short presentation. I'm going to come back for the Q&A, but I'm going to invite the team up now who are going to delve into some of these areas of interest we talked about, delve into some of the details that I just brushed over. And if they don't cover it, please have some questions saved for the end. But thanks very much. I'll invite them up. Hopefully music will play.
Okay. Well, first of all, good morning, ladies and gentlemen, and thanks very much for coming along today. As Taylor said in her opening, my name's Steve Fletcher. I'm a client portfolio manager at Munro Partners, and a really great part of my role is that I get to sit in on all the investment team meetings at Monroe. I get to observe the debate they have on a regular basis. Sometimes it's a vigorous debate. I get to watch them talk about what stocks they're going to buy, what stocks they're going to sell, and watch the risk management process really come to life, all anchored to one goal, and that is to deliver on our investment objectives. So over the next 40 to 45 minutes, we want to bring you into that room and share with you our insights, our thinking behind our decision making, and for you all to get a really good feel as to how we go about our business at Munro Partners. So what I might do is, first of all, start with a question for Kieran. Well, first of all, welcome Kieran, welcome Joel, welcome James. Thanks very much. Kieran, we watched earlier, just before at the start of the presentation, a video on the investment process. And that's all about trying to find that solution of finding those very, very few winners in the equity market. I was just wondering whether you can just dig a little bit deeper in terms of how Munro think about investing, how we go about investing, with that goal of delivering repeatable returns for our investors.
Yeah, absolutely. Thanks, Steve. So the first thing we do and how we think about the world at Munro Partners is we think about the world very differently to a typical fund manager. So as Nick alluded to at the start, a typical fund manager might think about the world in terms of those traditional sectors, consumer discretionary, healthcare, or they might think about allocating their portfolios around different regions around the world. So they might want to allocate more to Japan, more to Europe, et cetera, et cetera. We don't do any of that at Monroe. So the way we think about the world and where we want to find opportunities for the portfolios is through what we call structural changes. We call these structural changes areas of interest. So these are areas of interest. They're those platform shifts or those big changes that are actually happening in the world around us. And so if you're looking at the world through a sectoral lens or a regional lens, we don't think you're a very good chance of finding some of these really good structural changes. And so think about things like, as we showed you, digital media shifting away from newspapers and going digital, or things like spending on decarbonisation, or things like the proliferation of artificial intelligence around us. And so what these areas of interest are, they're really essentially structural changes. And what they really are in practice is we call them S-curves. Okay, it's a bit like what I'm showing you on the slide. So these are penetration curves. So these are things where the penetration of an industry starts very low and then accelerates over time. So a really good example of that is what we've seen in things like digital payments, where 20, 30 years ago, most of us in the room paid for things using cash. And over time, cash was a big portion of payments, and over time it became very, very small. And digital payments started at the bottom of that S-curve and accelerated over time to be now far more commonplace in what we look for and what we do in our everyday lives. The same thing's happening with things like e-commerce. The same thing is happening today with things like AI and climate change. And these are areas that are right at the start of the S-curve. So I think what differentiates us and what we're looking for day to day is these S-curve situations through these areas of interest, these big structural changes, which we ultimately want to invest in, and we want to invest in the companies that enable these big structural changes to happen. So if you think about that in terms of putting that into practice, what we've done for a long time now, and we've shown this slide to all of our investors when we do investor presentations for a decade now, is we're looking for companies with really sustainable earnings growth profiles. So we're looking for companies that can grow their business, grow their profits, grow their earnings from enabling one of those S-curve situations to play out. So who are the enablers of digital payments? Who are the enablers of AI? Those shovels in the boom, so to speak. And so the way to think about what the team does day in, day out is the best way to think about it through the two charts. So you've got MasterCard and Bank of America. The dark line is the share price. The light purple line is the earnings of both of these businesses. So how much money they're making each and every year for their shareholders. And so what you've got is a situation on the left where MasterCard has enabled one of those big S-curve situations to play out. So it's enabled digital payments to become far more commonplace and basically the majority of all transactions today. And so what that's done for that business, it's created a really sustainable light purple line that has gone for a long period of time and has ultimately driven the share price higher over that long period of time. The right-hand side, the Bank of America situation, that's a company that doesn't have that big structural change behind its earnings. So to work out where their earnings are going, you need to look at all those big macroeconomic factors. Really difficult thing to do. So what the team does through these different areas of interest, through these different S-curves, is try and find these MasterCard situations of really sustainable earnings growth over a long period of time. Because time and time again, this is what the market gets wrong, and this is where we can ultimately find opportunities for the portfolios.
Okay. Also in the video, Nick spoke about Munro's proprietary four-step investment process. I'm keen for you just to talk maybe a little bit more detail on the second part of that, where Munro believe the key characteristics of a truly great growth company exist. If you can just walk us through maybe those characteristics.
Yeah, so what we do day in, day out, these are the nuts and bolts behind finding those MasterCard situations. What we do day in, day out, we meet with hundreds of companies each and every year. We travel extensively. We find these opportunities. We find the shovels in the boom. And so each and every meeting that we do, each and every management team that we interact with, each and every analyst that we talk to, we're ultimately trying to look for what we consider 6 really important qualitative characteristics of any great growth business. So what we're looking for, firstly, under the step 2 on the slide, is the business has to be growing. I think that's really self-explanatory for a growth investor. Secondly, though, they can't just be growing, they have to be leveraging that growth. So what does that mean? They have the ability or the competitive advantage to expand their margins, to increase their profitability as they grow. Thirdly, we want the businesses to be really durable. So we want that growth to be durable. We want that profitability to be durable over a long period of time. So we love to find businesses that exist in a big total addressable market, that have a big opportunity in front of them. If you think back to the S-curve, they're right at the start of the S-curve. That's the optimal situation for us. We've got an ESG process that we've built up internally that we look at across all of our stocks that we invest in. And then the last two, Steve, down the bottom, I think are really important to us. They're fairly unique, but really important to us and really important for growth investments. So firstly, control. So control is all about investing in companies that have a high degree of alignment between the management team and the shareholder base. So we run a partnership model at Monroe. The idea and the goal behind that partnership model is to create that better alignment with ourselves and our objectives and your objectives as investors. And so when we put capital to work, we want to emulate that and find that good alignment of interest between management and shareholders. And then the last one, a critically important characteristic is the customer perception of the product. So great growth companies, what we've found time and time again over many, many years, is that great growth companies have great products. And that's really, really important. And so we always assess the quality of the product. And so if you think about all of that, think about some of the growth investments over time. Google, as the leader in search today, had all of those characteristics back in the mid-2000s. Yahoo didn't have all of those characteristics. Amazon has all those characteristics, eBay doesn't. Apple had all those characteristics. BlackBerry, HTC, they do not. So that's what we're consistently looking for, and that gives us the best chance of finding one of those MasterCard situations.
Great. Thanks, Kieran. Now, Chow, while we're talking about the investment process, I might ask you a quick question. At Munro, we have a very unique way of managing risk in our portfolios. But when you buy a stock, they don't always work out the way you first thought they would. So I guess the question to you is, how do you actually manage those stocks that don't ultimately work out?
Yeah. Hello, everyone. It's really good to be with you. Yeah, so that's actually quite a unique part of the Munro process. You know, Nick talked about lots of things we're really excited about, and Kieran talked about how we find these winners. But ultimately, when you actually look at the cold, hard statistics, the stock market is made up with very few winners and lots of losers. Stock picking is my passion. That's all I do. But I have to face the fact that most stocks that come across my desk, they're not going to work out. So that's actually step number one. Is across the team, we've drilled it in everybody's psyche. The most stocks that you look at will not work out. When the stock doesn't work out, first of all, you gotta face it. It's not an insult to your intelligence. It's not a breakdown of your process. That's just exactly what's supposed to happen. So then what do? You have to have a process in place to sort of deal with these mistakes. So the simple thing we do is very simple, but it's actually quite hard to do, is we have a stop loss trigger review. So a stock falls 20% for whatever reason. This stock could have gone up 10x before it falls 20%. Any stock that just falls 20%, it gets a stop loss trigger reviewed. So our office is across the street. You can go in and grab anyone from our 14-person investment team and say, what stocks are triggering across all funds right now? And they will rattle off a list of names that's triggering. That's how serious we take the triggers. Within a week of the stock triggering, 1 week, this is really important, a stock gets repitched. So everything that Kieran just talked about, growth, EPS growth, earnings durability, structural growing trends, everything from step 1 to 3 gets repeated in front of the entire investment team as if this were a new stock. Only when you get the entire investment team to unanimously agree to keep the stock do we keep it for a very limited amount of time. You have dissenting voices, real debates, people pushing back. We are committed to selling the stock or managing the size, meaning reducing the size very aggressively. The reason for this is really two reasons. One is ultimately what we want to avoid is situations like this. So when a growth stock falls, and we have 20 of these charts at Monroe, if you come in, we're happy to show you. The stop sign here in each one of these stock charts is after the stock has already fallen 20%. So we don't show you what happened before, but safe to assume it's fallen a bit, right? And this is when we review the stock in front of the entire team and someone raise his or her hand and say, I think we're missing something here. I think we need to get out. And thank God we did. We got out of these stocks, and these are household names, proper big cap stocks, and they will fall another 70% within 12 months after we sell it. So it's just a stark reminder and over again that when there is a problem, time is ticking. You don't have time to hide your head in the sand and say, maybe a bull market is going to bail me out. Maybe it's going to have a bounce. These stocks are not bouncing. So when we have one of these problems, what we do is we do this trigger review, we get it out, because ultimately what we try to produce for you is really charts that look like this. And let me maybe explain what we're doing here. So if you just look at the one to your left, the light orange shade is how much money we make. These are all actual stocks we own in Munro funds. How much money we actually make on the stocks we get it right for you. So NVIDIA is the biggest winner we've had for Munro Global Growth Fund over the past decade, and we make 2,000 basis points. So that's 20 points of P&L on one single stock. Most of the stocks in light oranges here are stocks that's got multi-baggers for us. And frankly, that's what you should expect out of your growth managers. We do growth stocks. When we're right, we should multi-bagging, we should multi-times your money. But what's much harder to do, which is really what the risk management system is trying to do, is what's on the left. So the dark purple shade shows how much money we lose on the biggest loser we've ever had. Now, quick reminder, we run concentrated funds that's in the growth equities market. So it's not uncommon for our stock to move 15-20% on one earnings report. Yet in 10 years of running money, Munro Global Growth has never lost more than 100 basis points. That's 1 point of loss on the biggest loser we've ever had. And which means the top winner versus top loser, the ratio is 20-1. And on average, the winner-loser is really, we're looking at 10-1 ratio. We know as a team, we love talking to you about, individual heroic stories of these stocks, but ultimately what you care about is the portfolio returns. And the portfolio return is made up of how much money we make on the winners and how much we lose on the losers. So cutting the losers small is critically important. And what really gives us a lot of pleasure is, we ran this for 10 years. And when we started a small mid-cap fund, there are lots of people that says, well, now you're going down the market cap. Now you're going to the market that's more volatile by nature. Maybe you should, give yourself a longer leash. Maybe you shouldn't be 20% stop loss review. Maybe you should be 30. And we said, no, we run the whole team exactly the same team, same process. We keep the 20%. And now we've run the small mid-cap fund, through pretty volatile times over the past 3 years, and what's being produced is really the chart on your right. So you're actually seeing a very similarly shaped chart with the biggest winner close to 1,000 basis points and the biggest loser also roughly 100 basis points. So that's really what proven to our team that this risk management process is working. As we roll through going into more periods of lots of AI disruptions, we actually anticipate these AI disruptions to come much faster, quicker, sharper than the traditional disruptions. It's really important to have this process already in place and having the team already develop this risk management muscle. So when a problem emerges, we get everybody involved, we handle the problem in a timely manner, and get it out of the portfolio before they become a large permanent loss.
Great. Thank you, Chow. And just to round out the part this morning on the investment process, I might hand it over to you, James. And a question we get quite regularly, it's a two-part question. So the first part is, do you use the same investment process across all of the 4 strategies? And the second part of the question is, in terms of the way the investment team is structured across those, how does that work across the different strategies? Who's got ultimate responsibility and who contributes stocks, et cetera, et cetera. So if you could maybe just walk us through that.
Yeah, so last question first. Everyone contributes stocks. We expect everyone to travel extensively, as Kieran said, and meet with companies all the time, so to never say no to a meeting when a company's coming through town or when you're going over to a conference, meet with analysts, meet with industry experts through expert network calls, etc. Build models, read extensively, read the press, etc., and come up with ideas, but also help prove up our existing ideas. And we ask people to work across all these areas of interest. The key caveat is obviously don't look at things that aren't structurally growing. So we want everything to be structural growth. We expect everyone to sort of contribute to each of these areas of interest. In terms of the earlier part of your question on sort of who's responsible for the funds. So Nick is ultimately the CIO. So he's got ultimate say so on the 2 funds at the top, being the Munro Global Growth Fund, Munro Concentrated. Kieran helps him on those funds. Chow's ultimately responsible for the Global Small Mid Cap Fund, and I'm ultimately responsible for the Purple Fund, the Climate Leaders Fund.
Okay, and while we're on the topic of just talking about all the range of the funds, with the addition of the Climate Change Leaders Fund and the Small to Mid Cap Fund, how actually beneficial has that been to the larger cap, the all cap funds in the Munro Global Growth Fund and the Concentrated Fund?
Yeah, so it's been good. Yeah, these smaller funds or these newer funds have helped prove up ideas, help us find ideas that we might not necessarily have seen earlier. Sorry, and I'll just find the slide. This is how we're sort of thinking about it, and bringing those ideas from climate and small caps up into the larger cap funds.
Okay, great. All right, what we might do now is move across to more of the exciting stuff. We're going to talk about some areas of interest. We're going to talk about some stocks. James, I might start with you as lead portfolio manager of the Munro Climate Change Leaders Fund. This is an area of interest that I know Monroe have been working on for almost 2 decades now, and you know this area particularly well, but might just be worth reminding us all, what actually is the thesis behind climate as an area of interest.
Like those other structural growth thematics that Kieran touched on, this is a very exciting area, but this one is probably, we think, got a longer tailwind behind it. It's probably going to go on for 30 years, maybe more. And so some clients were asking specifically about this area of interest and investing in a segregated fund. So we decided to launch it, and thanks again to the people that gave us the early support. And this is basically the 30,000-foot view in terms of the opportunity. And we put this slide together 5 years ago, and it's actually still the same today. But the $50 trillion in the middle is probably a lot bigger because there's been a lot of inflation in the supply chain. So this is how we were sort of thinking about it back then, and I think it's the same now. So this is basically what it costs to decarbonise the planet and the areas that need to be spent on to decarbonise. So $50 trillion plus opportunity, probably more like $100 trillion today, over 30 years to 2050 at least to net zero. And the sectors in the pie chart are basically where it's going to go to. And so this is per the European Investment Bank. So 24% to energy efficiency. So that basically means decarbonising buildings like this one with more efficient lighting, heating, etc., insulation. 18% to passenger EVs, so obviously replace your petrol car with your electric car. Charging stations, buses and trucks, heating. Renewables, obviously a big one, so replace coal, gas with wind and solar. Transmission grids, need to re-architect all that because you're obviously changing the generation source. Batteries, obviously to back up the renewables. Hydrogen, etc., probably more of a 2030 story. So those are sort of the rough areas top down that where the money's going to be spent. And then it's our job to find the companies that are going to basically sell the picks and shovels into this, just as Nick and the guys were explaining with the picks and shovels in the AI boom. So it's basically the same thing. So we're looking at the enablers within each of these sectors.
Okay, so effectively here you're following the money or the enablers of decarbonisation as opposed to this being a sustainable ESG or impact type strategy. Is that correct?
Correct, yeah, we're following the money and we ultimately think, although these guys are helping to decarbonise the planet, they ultimately are going to make a lot of profit out of that because they're going to be the next, if you take like the renewables companies, the next Exxon and Chevron is going to be some sort of renewable company. There's going to be a multi-bagger coming out of that sector. Someone's going to win that opportunity. And yeah, we're obviously hoping to find that beneficiary.
Okay. Just in terms of the Iran situation, how has the oil crisis affected the climate area of interest?
Yeah, so it probably just speeds up the disruption of the existing sort of fossil fuel-based economy. You've seen this over time, which we're plotting through over the last few decades in terms of the percentage of energy basically coming from oil consumption or power coming from oil consumption. You can see through those previous disruptions that the percentage coming from oil has always dropped. A more recent example is what happened in Europe post-Ukraine with the disruption of the Russian gas. Europe basically worked harder to decarbonise their economy quicker, to basically shift it from a oil and gas-based market to a electrification market faster. So electric heat pumps, EVs, etc., and those sort of Alternatives do exist today, as we're plotting there on the right. So those are the key beneficiaries of the faster decline of oil that we think will occur post Iran.
Okay. And just in terms of the climate, the portfolio construction, you break this down into 4 sub-areas of interest. Maybe if you can just sort of walk us through that and maybe provide an example as well.
Yeah, no worries. Yeah, so clean energy we think is the biggest one today. So if you think about that renewables piece of the pie that I showed, the transmission, the storage, etc., we think that is the key area. The other areas that we invest in as well is nuclear, which has been a good area for us as well. And I'll just sort of take you through this quick case study in terms of what's going on here. And the main opportunity right now is actually in America. Over the last 20 years, as most people that have travelled to America know, the infrastructure has been uninvested in for a long, or underinvested in for a long period of time. And the power sector has been exactly the same situation. And the reason that has happened is because of basically globalisation. So they've lost a lot of industry. Power demand has been very flat, as you can see from the slide here, over the last 2 decades. And so all of a sudden, things have changed. Things have turned the other way. So Donald Trump's come in, and obviously a lot of industry is coming back to North America. You've got the existence of EVs starting to take share, which obviously when you move your petrol car out of your garage and put an EV in, you're using a lot more power, electricity. And then the last one, which is the biggest one, the biggest driver, is actually the data centre, so the power-hungry data centre. And so you're seeing this sort of inflection in demand, and so that basically means more demand for those products that we're those picks and shovels that we're trying to invest into here. And the key sort of long-term solution we think is actually solar and wind, but paired with storage. And so solar and wind are quite difficult markets to make money in, but storage is a much better market to make money in. And the key company we like here is a company called Cattle, which I'll just touch on quickly. So Cattle actually started, if anyone has an EV at home, Cattle actually started with EV batteries. The fastest part of its business now is actually storage. So as you're building solar and wind farms, pairing up with stationary storage, basically similar technology that they also provide. So we think that they're a key beneficiary of the shift from fossil fuel-based power to wind and solar. Wind and solar, I know that not everyone agrees with the reliability, particularly of it, but they are the cheapest form of electricity based on a levelised cost of energy in terms of like the industry stats that you see, far cheaper than building new gas and definitely new nuclear, which are very expensive. Gas generation costs have gone up a lot, and nuclear, there's only been 2 plants built in the US in the last few decades, and they both went significantly over time and significantly over budget. So very, very difficult to do. So we think that the solution is ultimately storage. The other good thing about the storage market is that there's fewer players in that market. So it's a consolidated market, and this company, Cattle, is by far the leading company. And when we see these sort of platform shifts or these technology shifts, generally the bigger keep getting bigger because they reinvest in R&D, and the others just can't keep up. And so the key chart here to look for is a chart on the right-hand side where you see the market share of Cattle go up because the recalls and so forth are going down. The others are all struggling with their technology. And then just sort of to round this out in terms of how we think about the stock, Kieran already laid this out, so I won't go into it in detail, but the reason this stock won and maybe not one of the others that started a few years ago is because of the quality of the product, which is basically underpinned by the strong controlling shareholder and militant focus on the customer perception of the product. So that has basically helped that company grow and take that lead. So similar sort of to what Kieran was describing with Amazon, not eBay, Cattle, not Samsung SDI, etc. Similar framework.
Okay. Thanks, James. Kieran, I might move on to you, and we're going to ask you about infrastructure because that's a key area of interest across all the portfolios today. And I think some people may be surprised that infrastructure is one of our top areas, considering we're a growth manager. So maybe you can talk a bit about that.
Yeah, absolutely. So look, there's lots going on from an infrastructure perspective, particularly in the US at the moment, which is providing some great opportunities for us to go and try and find one of those really nice MasterCard situations of earnings growth and earnings acceleration. So if you look at what's happening in the US, and this sort of stems out of what Nick was talking about earlier with the US administration being supportive for equity markets and supportive for corporate America. So if you think about what's happening in the US right now is that we've got a massive build out a very, very large build out across a range of different industries and a range of different end markets. So there's traditional infrastructure projects that are going on. There's infrastructure semiconductor fab equipment projects that are going on. So TSMC is diversifying themselves away from Taiwan and building a major fab, which is a semiconductor producing facility in the US. We've got all that energy storage facilities being built out. We've got LNG being built out around the Gulf Coast. If you look at what's happening from an AI specific point of view at the moment, if you look at the bottom left situation, you've got these major data centers being built out. Trump's holding up a picture there of one of the Meta data centers, and he's showing you the size of that data center versus Manhattan Island. The size of this data center in terms of its physical footprint makes up a significant portion of the size of Manhattan Island in the US. These are major facilities, so that presents a great opportunity for us to go away and try and find some of the earnings growth that's out there. If anyone's been following what Elon's been doing around SpaceX, we're building out infrastructure to support and cater to space exploration and space technologies. So you can see some major projects in the US happening right across the spectrum at the moment, and that presents good opportunities. So if we hone in on one of them, the one that we've focused in on, that we've talked a little bit about so far, is that data center opportunity. And so what the team did, when we do that bottom-up research, when we go and meet the management teams and talk to the analysts and talk to the industry people, what we effectively did with the data center is we acknowledged, or we built out the entire supply chain, right from the first piece of electricity that comes into the data center, all the way through to the ChatGPT or the Anthropic that's answering those questions each and every day that we ask it. And so what becomes important is that any company that can play a role through that entire valuation chain, from the first piece of electricity all the way through to the ChatGPT model, can potentially grow its earnings, grow its business, generate more profits, generate a durable earnings runway for the business over a multi-year period. And so this framework, this supply chain, looking at identifying those shovels, has been a particularly positive one over the last couple of years, in particular for the strategies, where we're finding lots of good opportunities today.
Okay, and I noticed there's a logo, Comfort Systems. I think this is a really good example of Munro being able to find a stock really early. I mean, what did you like about that company at the outset? And where do you think it's at today? And it's how is it positioned, I guess, for growth moving forward?
Yeah, so a number of years ago, we found Comfort Systems. So this is a Houston-based company. It's called an EPC contractor. So what it does, it's responsible for providing the labour force, the mechanical and electrical engineers, to help build out some of these major infrastructure projects in the US. And so 3 years ago, one of the analysts, Dan, and myself, we went off to Houston. We turned up first thing on a Monday morning and we went to the offices of Comfort Systems. We weren't too focused because we'd had some pretty horrible Houston coffee the morning of, but what we found was ultimately a situation where this business is an industrial company. It provides mechanical and electrical services engineers to effectively build things. And now this business has a major, major tailwind behind its ability to grow, behind its ability to generate profitable cash flows over a long period of time, which is this data center infrastructure that's happening. And so what we found was that these guys were really well positioned to help build out the data center infrastructure, particularly in Texas, where a lot of it's happening at the moment. And as a result, what we found was an opportunity of meaningful earnings acceleration 3 years ago. And so time and time again, what we're looking for at Monroe is that chart on the top right. We're trying to show or find that MasterCard situation in a totally different industry here, a totally different business type, but it's the same principle where the earnings have meaningfully accelerated. That grey line on the top right-hand side is meaningfully accelerated as this business has been able to apply its skills and apply that alignment into driving what is a big data center infrastructure build out. So this has been a really strong performer for several of our funds.
Great. Thanks, Kieran. Chow, in Nick's presentation earlier, he showed the picture of the AI stack and took us through the 5-layered cake. I know that you and the team are super excited about the opportunities within the bottom part of the stack, or what we call the picks and the shovels. The question for you is, how do you actually then go about uncovering these gems in that part of the stack?
Yeah, happy for that. Connectivity is a generic term, but it really sort of now covers a whole slew of really exciting companies for us. So, we just maybe just take a step back and set up the problem. So what is the problem that we see in the industry? So Nick talked about the hyperscalers now spending, call it close to $1 trillion a year on overall CapEx building out these data centers. And a big proportion of that CapEx is being spent on really, really fast chips made by the NVIDIAs of the world. Well, these chips are really fast and they're iterating, every year and going up 5x, 10x in speed. What happened is, well, the chips are really, really fast, but what's connecting the chips, they need to talk to each other constantly. And they're talking through the equipment like, Ethernet cables, transceivers, switches within the data center, and these equipments can't keep up. So a visual way of thinking about this problem is, the chips are fast, they're like Ferraris. And actually these chips are so expensive that you link 10 of them together, they actually cost like a Ferrari. Today, people are linking tens and thousands of these chips together in one of the data centers. Soon, in the data centers the size of Manhattan, you're gonna need hundreds and thousands of these chips constantly talking to each other. If the transceivers, the switches, the Ethernet cables that help them speak to each other can't keep up, it's like having hundreds of thousands of Ferraris being stuck on the road, but the road is full of potholes and the traffic lights don't work and you come down to a traffic jam. This problem is so big that as of now, as we speak, lots of these really big, expensive data centers, up to 40% of these expensive NVIDIA chips are sitting there idle. Not working, not making tokens, not selling tokens. This is really how big of a problem we're dealing with. We do exactly what Kieran did with infrastructure. We identified a money-making nugget. In this particular case, this nugget is, hey, the connectivity, the connection equipments are not keeping up, and this is creating a really expensive problem. So we go to the back of the data center's rack, and we basically break apart the rack for you. And we say, all right, what are the companies that's actually helping to solve this really expensive problem? We start with the switch chips. So a switch chip is the ultimate traffic cop within the data center. It tells you a text data goes that way, images go that way, video goes that way, logic go that way. And the fastest switch chip in the world is made by a company called Broadcom. It's a over $1 trillion market cap, and it's been a long-term holding of Munro Global Growth. And then we go from there, and then we start finding the companies that, actually make the hardware, the house, these really expensive chips. So we found a smaller company called Celestica. We also found really clever companies like Credo that basically said, if the Ethernet cables are too slow, why don't I put a really smart, fast chip inside that cable and make it faster? And eventually, even with the most clever maneuvers, copper as a material, as a base material, is running out of gas. This data transmission rate is so fast and it generates so much heat that copper just cannot supply that speed anymore. You have to go to optical. Literally, the data needs to go back and forth at the speed of light. And we found 3 optical companies that's all benefiting a lot from this build out of faster speed connection. The really compelling thing about networking for us is, with the exception of Broadcom, which commands over $1 trillion of market cap, every other company on this page, they're solving a critical problem that is strangling a $1 trillion industry. Yet this is a small mid-cap company. The average market cap of the companies you're seeing is between $30 to $50 billion. And the average revenue that these companies actually generate is between $1 to $2 billion US annually. So what eventually happened is we found a big problem, a huge budget, is basically getting stuck with the industry with these little bottlenecks with all these small companies. And what happens to the earnings of these bottleneck companies? They're inflecting in a dramatic way. So most of these logos you're seeing here, they used to grow revenues long-term average roughly 10% for as long as they exist. Last year, most of them grow 50%. Next year, most of them are going to triple-digit growth. because the problem they're helping to solve is so big and the company base themselves is actually so small. So we have a little bit of a joke internally. We say this is literally like squeezing a pig down a python. Long, winding supply chain, and you just get these small companies inflect massively. And networking or connectivity is actually the top contributing performance to both the small mid-cap fund and one of the top ones to Munro Global Growth over the past few years.
Okay. And just a follow-up question to that. So you spoke about the bottlenecks within the connectivity area of interest. We can also see some companies that have actually helped solve that problem. In terms of other areas of interest that Munro look at, do bottlenecks present stock opportunities elsewhere?
Yeah, so I think you've now seen two massive industries. Kieran first talked about infrastructure, where we identified there's a power shortage. Let's find a whole slew of companies that help solve the power shortage. And now here we found a connectivity breakdown. Let's find a whole slew of companies that provide solutions. So we've actually taken this same way of thinking to an entirely different market, but also a $1 trillion market. And this time it's in travel. So globally, in case you haven't noticed, we're actually in a structural shortage of commercial airplanes. So a really quick way of thinking about this is human beings, we love traveling. So global travel demand actually goes up roughly about 5% every single year. COVID sort of shut that down and then basically come back, raging back. The supply side is an entirely different story. There are only two big companies that actually make these big airframes for us, which is Boeing and Airbus. Boeing is a mess, and the supply chain basically cannot really adapt, and they still have all sorts of disruptions after COVID. So simply put, right now, 2025, 2026, relative to pre-COVID, the global supply, the global travel demand for air travel is actually 40% higher, which makes sense because you compound roughly 5 to 6% a year. Yet, the total new planes being produced on an annual basis this year right now is still below what's pre-COVID level. So as a result, the existing planes can't retire. They have to keep flying. They have to keep flying longer. They have to fly hotter. They have to fly till they're older. So this is really the problem that we identify. Again, $1 trillion industry. And then we, this time, break apart the plane for you. We said, well, what's really making these planes so hard? Why can't Boeing and Airbus get their act together? Well, the first bottleneck we found are the engines. So we call Boeing and we call Airbus and say, why can't you deliver the planes to Qantas? And they said, well, we don't have engines. So we said, well, that's interesting. So we end up owning 3 engine makers globally, all for Munro Global Growth: Rolls-Royce, GE Aerospace, and Safran. And basically, those are the only engine makers in the whole world. We didn't stop there. Then we called the engine makers and we said, why did you not send Airbus their engines? And they said, well, we don't have blades. We said, well, that's interesting. Who made your blade? This is how we found Howmet, which turns out an exclusive provider for the highest end blade. And then we call Howmet. We said, why did you not send Rolls-Royce their blades? And they said, well, because GE Vernova called, and they also want our blade for their really large natural gas turbine. And we said, bingo. That's really how we end up working out why there's basically multiple really large structural demand trends pushing one small company, and Howmet is actually a small mid-cap company, so we end up buying Howmet. Then we also worked out, hey, if these planes, the older planes, they can't retire because there's no new planes. They have to keep flying. Well, the older planes need a lot more maintenance. They need a lot more parts. So then we go around and we found all these companies supply parts to airplanes and also supply services to airplanes. So we basically end up following this one money-making nugget and this one insight, and then finding about 4 to 5 companies in Munro Global Growth. And we also found about 4 to 5 of these smaller companies, and they become portfolio holdings for the small mid-cap fund. And then we've all heard about SpaceX, and we're all really excited about it. You know what? There is a whole mundane supply chain of just good old airplane parts that also go to space. So we just think this is a really classic example where we thought the demand was really great. Turns out demand is even better than we think because it's a collision of multiple of these really large trends. And then we found a whole slew of companies, frankly, nobody's looking at. We end up buying them, a pretty old school industrial company multiples, and they have been strong contributors to performance.
In terms of examples, Chow, is there another slide there? We're going to just quickly run through an example, maybe just after that. Is there any comments you wanted to make on Howmet? I know you've just covered Howmet a bit, but...
Yeah, what is there not to like about Howmet? Just did a whole pitch. Well, it turned out making a blade is really hard. So if you think about the hardest part of the engine is the blade. And the blade have to turn at very high speed, and they have to work, one of these flights, you get on a flight to Dubai, you get a flight to London, they have to fly 14 hours nonstop. So this is one of the hardest things to make. It is also one of the most critical part within an engine. This became so difficult that most of the industry competitors basically fall off. So Howmet is actually a spin-off from Alcoa. So they end up producing the initial compound machine powder. They end up doing all their own grinding. They basically put together this entire blade completely from their own vertically integrated supply chain. So for a while, this keep compounding as the critical supplier to the commercial aerospace industry. And then just like I said, GE Vernova making these really large natural gas turbines because we now have a power shortage, start to use their blades. Turns out the military planes, so we see defense budget also going up, they also need the same engines that use the same blades. So you basically end up having this situation where these blades become critically important for, call it 2 or 3 of these really large trillion-dollar markets. And then what happened is not only your sales start to inflect. So this used to be called 7 to 9% sales growth. Now it's solidly growing sales, 15 to 18%. But more importantly, you can charge basically whatever you want. So Howmet has incredible pricing power, and that basically come through in a really sharp acceleration in earnings growth. And that's really why we like it.
Terrific. Okay, let's move our minds now to how Munro are thinking about markets moving forward. So let's talk a bit about positioning. We can talk a bit about performance as well. At the start, Nick spoke about the amount of volatility that's been in markets, driven by the ongoing wars, geopolitical events, bond yields rising, and also the growth in AI. But also we've seen spectacular earnings growth this year as well. So I'm going to ask each of you about how your portfolio is positioned today. Kieran, I might start with you, and we're going to talk to you about the Munro Global Growth Fund, or MAET. This strategy is coming up to its 10-year anniversary in a few months' time. Nick also outlined that the goal of this fund is to deliver double-digit returns, but create a smoother journey for investors through the cycle. So I'm keen to just ask you about these tools that you have available within this strategy that are going to help dampen or remove some of that volatility for investors.
Yeah, absolutely. So look, first things first, when you think about the Munro Global Growth Fund, remember our objective there is the double-digit returns over the 3 to 5 years. And so how we're going to get those returns is through all the attributes that you see in the light green boxes. So this is our stock picking process. This is us going out and finding things like Howmet. This is us going out and finding things like CATL in China. So we've got a very disciplined and rigorous process around how we model stocks and find opportunities. In the Global Growth Fund, our job is effectively to gear the fund towards that double-digit return as much as possible through the cycle. And so we have these extra tools available to us, which are all the attributes in the dark green boxes around the edges that effectively govern that stock picking process and help us manage through difficult periods in markets, whether it's Liberation Day, whether it's COVID, whether it's the Federal Reserve hiking into a slowing economy. And so these are the tools to help us preserve capital and minimise volatility in the fund. And so firstly, we've got the ability in the Global Growth Fund, or MAET, to hold more cash. So that is, we can sell stocks under that stop loss rule, for example, where a stock has fallen to 20%, we might step to the sidelines when things are getting really difficult and just simply hold cash in the portfolio. We've got the ability to use things like options. So we can buy a very small amount of a put option on the S&P, for example, where if the S&P were to fall, that option should in theory increase in its value. And that can help protect the fund and offset what is going on in the market. We employ those stop losses on the individual positions, and we've got in that portfolio the ability to also short sell in the Global Growth Fund. So what that means is obviously profiting from businesses when their share prices fall. And so that helps us, again, navigate through really difficult periods in markets and benefit the portfolio through shorting stocks through very difficult periods. The last one that's really relevant this year in particular is that we've got the ability to hedge the currency in that portfolio. So obviously when we buy these stocks like Howmet or Comfort Systems, for example, when we buy them in the US, we need US dollars to pay for that stock. And so therefore your return on that position is subject to both what the stock does, but also what the currency does, the Aussie dollar versus US dollar. And so in the Global Growth Fund, we can hedge the currency, and we've hedged predominantly most of the currency today. We've hedged back to Australian dollars, so we're minimising the risk we have when we invest offshore from a currency perspective. And so that's helped the portfolio protect this year from an absolute sense. Obviously this year, the Australian dollar is up about 7% against the US dollar, and that hurts offshore investors. That can protect the portfolio a little bit more.
Okay, great. And a question we get a lot is, what is the difference between the Munro Global Growth Fund, or MATE, and the Munro Concentrated Global Growth Fund, or MCGG?
Yeah, so it's important to think about the Munro Global Growth Fund is your absolute return product, so the double-digit return. Concentrated, the long-only portfolio, is, as Nick said at the start, that fully invested portfolio into the same areas of interest in the Global Growth Fund, but without all the downside protection tools. So we don't have the ability to hold more than 10% cash in that portfolio. We don't have the ability to short sell. We can't hedge the currency. We don't have the ability to buy put options. What we do across all the portfolios, which all of the portfolios get to benefit from, is, as Chow talked about, that 20% stop loss rule, where we review each and every position that falls under that rule. So the concentrated fund, the way to think about that is it's got all those attributes again in the light green boxes, but without all those dark green boxes around the edges.
Okay. And just wrapping up this section on global growth and concentrated, you just want to walk us through how the funds are performed and also how you're positioned moving forward.
Yeah, again, so look, thinking back to what really one of our values is as a business, we ultimately want these products, and we've set this business up to effectively deliver ultimately good objectives for clients through the cycle. So we want the Global Growth Fund to deliver those double-digit returns over the 3 to 5 year period. We've achieved that, or we're doing what it says on the tin, which we like to say internally. The fund is up it's compounded at 13.4% per annum since we started in August 2016. So some strong absolute returns through the cycle there. In terms of positioning, where we've positioned the portfolios, the way, remember, to think about how we've got all of our strategies positioned is through these areas of interest. Remember these S-curves, these structural changes in the world within which we're trying to find the MasterCard situation, or the situation where we can invest in a sustainable earnings growth company. And so this is the top 8 areas of interest in the portfolio in the blue bars right now, as at the end of April. And so the blue bars represent the percent of the portfolio in each of these different structural S-curves. So you can see the biggest one that Chow talked about is connectivity. You can see climate is a big area for us at the moment, and that's where stocks like CATL or CATL come in. High performance computing with companies like NVIDIA is still a core part of the exposures in the portfolio. Power generation. We also like opportunities in security. So security is all about defence and public safety spending. So we have opportunities in that area of interest or in that S-curve. And then down the bottom, we've got things like infrastructure, innovative healthcare, and then e-commerce down the bottom. So these are the top 8 areas of interest or exposures in the portfolios right now in the Global Growth Fund. I'll just touch on the concentrated fairly quickly. So remember, the concentrated portfolio is a little bit different. So it doesn't have all those dark green attributes around the investment process. What it does, it invests in the same areas of interest as the Global Growth Fund, but it does it in a way where we want to be fully invested all the time without all those downside protection tools. So the objective here from a performance perspective is to outperform the benchmark over the medium term, over that 5 to 7 year period. And so you can see since inception of the product, this fund has meaningfully outperformed the benchmark over that time. So again, doing what it says on the tin for the clients and investors. In terms of the exposures, look, I won't go through the detail here. It is effectively the same exposures as the Global Growth Fund. So we invest in the same positioning under the surface, just without all those tools that I mentioned. So connectivity, climate, high performance computing, et cetera, et cetera. The exposures in the dark purple bars are the percent in each of these different areas that we've got in the portfolios. And when you think about this, just finally, when you think about these different areas, you can see that for us, growth investing exists across the entire spectrum. So it exists in travel and aerospace and climate change and decarbonisation. It exists in semiconductors and infrastructure and healthcare. So we want to create portfolios with a range of these different areas of interest.
Great. Thanks, Kieran. We'll move across now to James, who can talk about the climate fund. James, very, very strong year, 12 months, up 51%. I'm sure everyone's pretty keen to understand, what contributed to that performance, and then maybe you can walk us through how you're positioned moving forward and thinking about the rest of the year.
Yeah, no worries. Thanks, Fletch. Yeah, the purple line has basically been driven by the EPS of these companies, or the earnings per share of these companies. So the earnings per share is going up because, as we said, earnings per share is driven by the structural growth tailwind that these companies are playing into. And so a lot of these tailwinds are in the very early years. So if you think about EV penetration as an example, it's very early. If I ask for a show of hands, I reckon there'd be 10% of people in this room that maybe have an EV. So that's very early in the S-curve. So that industry is growing very, very fast. Solar penetration in the power grid, same thing, low, but growing very, very fast. So that's why you sort of see higher returns in these areas of interest that are earlier in their S-curve. Kieran mentioned the S-curve of MasterCard. That's one that's more penetrated, it's more mature, so those companies are now growing slower. These guys are at the start of the S-curve, or a lot of them are at the start of the S-curve, so they're growing faster. And so long as that earnings per share line for those companies that I talked about, the picks and shovels, is still in the formative years, hopefully over a medium to longer term period of time, that purple line will keep following that up. And the team's obviously done a great job in terms of finding good ideas as well. So the analysts have done a great job. The guys here have done a great job. We've managed to pick some winners and avoid some losers, as Chow was sort of saying earlier. Stop losses have also worked here because in the formative years, you make mistakes. You pick Samsung SDI, not CATL, and then you realise your mistake, and then you pick CATL and get rid of Samsung SDI.
Okay. And in terms of the AOI exposure?
So as I mentioned earlier, clean energy is the biggest area because that's the part that we see happening today. I sort of showed that pie chart, and there's some interesting things on that pie chart. But at Munro, we like to invest in the picks and shovels that are benefiting today, not the picks and shovels that are benefiting in the 2030s. And so that's why you see a lot of these clean energy companies here. Part of the pie chart that I showed was the hydrogen stuff. And, 5 years ago, not so much now, but you used to get a lot of questions about hydrogen. That's something we don't invest in today because the companies aren't making money in that area. That's more of like a 2030s, 2040s story. So, a lot of the positioning for our funds is predicated on companies that are growing their earnings faster today. So that's why clean energy and to a lesser extent energy efficiency, HVAC companies, etc., lighting companies are the key positions today.
Okay, terrific. And finally, Chow, we're going to just have a quick chat about how you're feeling about SMID going forward, the small and mid-cap fund. Maybe a good place to start there is just to sort of remind people in the room as to why Munro decided to start this fund around about 2.5 years ago. It's been a great performer. It's up more than 100% since inception, and it's also been a great contributor to the other funds. So maybe if I could ask you that question.
Yeah, so we started the small mid-cap fund really sort of for two really simple reasons. One is we just realized the small mid-cap end of the market was just getting really cheap. So when we first started the fund, and amazingly, it remained true today, that the valuation gap between small and mid-cap stock as an index, so you can look at the Russell versus the S&P, you can look at the bottom end of the S&P versus the top end, you can look at however metric, the smaller side of the market relative to the larger side, the biggest valuation gap in 20 years. So we said, well, that's a pretty interesting setup to go start a small mid-cap fund. But that's only half the reason. We're growth investors. Most of the stocks in my index, frankly, I have no interest in. So the second reason, which is a more compelling reason, is these companies are growing really, really fast. And as a growth investor, when you find something that's really cheap and nobody's looking at and is growing really fast, that's pretty much the holy grail that we're looking for. And it turns out we actually do have a way of finding them. So the biggest problem in small mid-cap investing is discovery. There are 6,000 companies in my index. There's another about 5 to 6 that we could invest in that's not even in the index, and they're everywhere in the world. Where do you start? So we started something really simple. We just said, look, we know the areas of interest. There are 20 of those in Monroe. Roughly 7 to 8 of them we are really excited about. And these are multi-year trends in trillion-dollar markets. We're going to start there. And we're just going to go down the S-curve and find the small companies that's growing really fast, yet benefiting from the exact same trend as NVIDIA, yet benefiting from the same trend as GE Vernova, same trend as Airbus. We're just going to go down the market cap and find these companies. So it turns out, I use the analogy, it's a little bit like an Easter egg hunt. And our holdings in the large cap companies are basically telling us, go to that corner by the tree and turn over a few stones. And then we go over there and we found a whole bunch of them. So the hit rate has been quite high following this method. But even more compellingly, I would say, is we engage the entire team to work on this small mid-cap fund with me. And this is just a huge luxury. Most of the small mid-cap funds in the market are run by much smaller teams, 1 portfolio manager, 1 or 2 analysts. From day one, the entire 14-person investment team, to James's point, same team, same process, run this fund. All of them have at least 1 or more stocks in the small mid-cap fund that they're directly responsible for. So the outcome is you can actually put together a small mid-cap fund, pure growth, all on the, what we call tip of the spear in terms of the growth curve, yet very diverse and really across a wide range of areas of interest. And that's because we genuinely get the entire team involved.
Fantastic. Okay, well, ladies and gentlemen, that concludes the formal part of the Q&A. And what I might do now is ask Nick to come back up on stage. And what we'd love to do now is get your questions. We're going to have some roving mics around the room. So maybe while those mics come down, I might just start with a question. And please just raise your hand and a mic will be brought across to you. Here we're talking about memory chips. How long can the memory chip last? Are we truly in a secular bull market for memory stocks?
So the short answer is yes. So what's really interesting about memory, and maybe I'll just give a really quick sort of overview. So memory for about 20 years, ever since the development of semiconductors, has been considered a commodity cyclical market. You have roughly 3 memory makers in the entire world. That's it. Nobody else can make leading edge memory outside of 2 companies in Korea, Samsung and SK Hynix, and Micron in the United States. It's really, really hard to do. But for a while, this is capital intensive. People say it's a boom and bust commodity market, sort of like not even that different from the iron ore market. And then when AI come on the stage, when Nick started talking about all these AI agents needing 10,000 or 1,000 times more tokens, they also need 1,000 times memory. So all of a sudden, there was a really sharp acceleration in the actual demand for memories. And now, sort of very similar to how we talk about bottlenecks. Now the production of these memory chips have become a real bottleneck because these 3 companies literally physically cannot build fabrication factories fast enough anywhere in the world to actually supply to the dramatic increase in compute and memory. So the outcome is when you have a commodity supply surge, what supply can't keep up, demand surge, what do you have? You have a pricing spike. This is really why we see memory companies really having probably the best structural tailwind to their pricing increase that we've seen in our entire investment career. And then the margins of these memory companies basically went from through the cycle average called mid-teens to now enjoying north of 80% of margin. And that's really how you see 2 of these companies end up becoming trillion-dollar market cap companies.
Yeah, the only thing I'd add is you're obviously getting supernormal pricing here, no different to the supernormal pricing we got in iron ore for a decade. The trick is to work out how long it'll last for. We think it lasts for at least 5 years. These stocks actually only trade on 8 times earnings. That's how much their earnings have gone up. So the stock's up 1,000, and the stock's up 100% this year, and it's cheaper than it was at the start of the year because their earnings gone up. So all 3 of those companies trade on less than 10 times earnings today. So the market doesn't think this is going to last very long. It's probably going to last a bit longer than everyone thinks. So we still like these stocks today.
And just as a side note, the shortage is actually getting worse.
It's getting
So
worse.
these three companies, they're building as fast as they can, but because demand is running so far ahead that the bottleneck, the actual shortage of memory is much worse now than a year ago. And then if you actually see, the hyperscaler CapEx go the direction, that next year the shortage will get even worse. So the problem they're trying to solve is actually getting worse, and that's really why we think we're probably still closer to the start than even halftime here.
Question. Nice.
Thanks very much for your presentations. They're great. My question is about your stop loss mechanisms and how you manage that downside volatility. In particular, out of those companies, is 20% like an empirical number that you've set, or is that something that you've identified through the way that companies fail and then regrow? And then secondly, just to ask, what percentage of the stocks you invest in actually hit that 20% downside? And then thirdly, how many of the ones that you continue to hold actually do well, or how do they compare against the ones that don't go below 20%?
All great questions and things we've studied. So I'll give you some numbers. So the 20% is just an empirical number. It's not a number that we've worked out as a good number. It's a number, we would call this a reaction function. So we don't have to sell when it hits 20%. We just have to repitch the investing case. So let's react faster than everyone else. Does that make sense? And the simple question is the price telling you something, or is it just like Liberation Day or COVID or something like that? And so it's a simple reaction function to repitch the investing case. And sometimes this is really easy. And so when we repitch the investment case, we're basically saying, have the facts changed, or is this just the market? Now in COVID, this was really easy because the entire portfolio triggered in COVID, every single stock triggered. The first stock we have to review is Airbus. Has anything changed for Airbus? Well, yes. It's reasonably simple to work that out. Maybe in a DCF it'll be fine, but in the next 5 years it's probably got a problem, and we only set 5-year price targets. Second stock to trigger is Amazon. Has anything changed for Amazon? No, it probably hasn't. If anything, it's got better. So let's sell the Airbus, and let's react on Airbus because the facts have changed. We should change our view, and let's not react on Amazon. That's sort of how we think about it. Last year, all our software companies triggered. They all triggered actually last year. We reviewed it. Chow showed the Adobe and ServiceNow chart. And I'm the stock champion on ServiceNow. We've owned it for 10 years. It's in our top 10 winners of all time. But the more we reviewed it, often we review it and we decide to keep it, but we can only keep it for 30 days. 30 days time, it's triggering again. 30 days time, it's triggering again. And after a while, we keep pitching the bear case and we realize, why are we paying 45 times for a company that we're not actually quite sure what's going to happen 3 years from now? And so we just stepped to the sidelines. We thought it was a bit 50-50 as how it was going to work out. We stepped to the sidelines. It ended up working out negatively. We can always come back. Our brokerage rates are really low, okay? So for us to leave and come back, we can do that. So think of it as a reaction function, and think of it, the partners, particularly these three, who we all own the business together, are helping you out of a bad situation. I always, we're all deeply in love with our stocks. I mean, how can you not be? They're great companies. You hear us talk about them. Well, like in any good relationship, sometimes you need a friend to tell you that it's not working out for you. And that's how it works. The other way to think about this is every person in this room invests privately, I suspect. You're all direct investors. You've all got stocks that you've lost 90% of your money on. I'm sure you do. They're sitting in your bottom drawer. It was a good idea at the time, just didn't work out. And all you're doing is just reacting to that quicker. Here's some data for you. We actually worked it out. We did the Munro Global Growth Fund. It's been around 10 years. We've obviously sold a lot of stocks because we chose to. But in that time, there's 106 that have actually been triggered out, i.e. we're taking that out of your hands, or you've decided to just step away. And of that, 70% of them have actually gone down since we sold them, and 95% of them have underperformed the index. So there are some that got away. And this doesn't include things that we sold and bought back. So for instance, we triggered Netflix in COVID, but then bought it back, in 2022, but bought it back a year or so later. So we think this is invaluable because just do the maths. It's pretty simple. Every company you're investing in is growing roughly 15% per annum. If the 15% per annum, provided you are really disciplined about your risk controls, then you're effectively mathematically solving for 15% per annum returns, provided the stocks just follow their earnings, and the stocks pretty much always follow their earnings on any sort of medium-term view. That's how we think about it. hopefully that helped.
Okay. I'll jump in with another question. We had this question submitted before the session today. So it's a two-part question just regarding the regional diversification of the fund. Just trying to understand the thought methodology behind having a larger exposure to the US, more than half the fund typically across the funds that we run. And also the second part of the question is, why do we have such a small exposure to Asia, given the major technological and growth opportunities within Asia?
Okay, I'll start and maybe you guys can jump in. So just really quickly, like everyone talks about US exceptionalism. In my opinion, in our opinion, it is real, okay? The reality is things get done quicker and better in America because they do capitalism really well. Capital goes where capital's treated best, and America does it best. And so Kieran showed the slide of everything being built there. It is truly being built there. Regulation barriers are being broken down. Things like SpaceX are allowed to happen in America. I'll give you one simple example. Australia used to make the most LNG in the world, okay? We did. We had the Northwest Shelf, we had Gorgon. The US had the highest gas price in the world. The US, through ingenuity, discovered fracking. Fracking was allowed to happen in the US because they have lighter regulatory controls. Fracking lowered the gas price from $15 to $2. The US went from importing gas to exporting gas, and now they're the second largest gas exporter on the planet, only behind Qatar, which has got a problem, I think, recently. So probably about to become the largest gas exporter in the world. And all of that happened in less than 20 years. The same thing's happening with AI right now. So follow where the money's going. The money's going to America. And then in terms of Asia, yes, we don't pick by region, we pick by company. So we own TSMC in Asia, we own CATL in Asia. If they're a leader, we will definitely own them. And we own some of the Taiwanese supply chain that Chow pointed to earlier. Last thing I'd just say is, and I'll let the guys jump in here if they want to, we're thinking about taking the whole US. Well, I think we're about taking the fund and showing you by Asia, by Europe, by the US, and by Texas. Because Texas is literally 30% of our fund at the moment. And I'll let the guys roughly explain why. I don't know which one of you wants to take it, but we're literally thinking about doing this. We're spending a lot of time in Texas at the moment.
Well, yeah, I mean, to Nick's point, that's where a lot of the growth is going in. So I spoke about solar and storage. Texas is the fastest growing storage market. It's traditionally a pro-oil state, obviously. But, to Nick's point about light touch regulation, I mean, Texas is the poster child. You can get things done quite quickly. Of course, you've got to be careful because there's literally a lot of cowboys down there and a lot of companies also that give you a lot of grief if you're not careful because they overpromise and underdeliver. But yeah, a lot of Texas is going very fast and there's some awesome companies down there. Kieran talked about Comfort Systems in Houston. I think we've been there to their various facilities, multiple times now over the last 5 or so years. Quanta Services is another one from Texas. The Gulf Coast companies as well, not far from, or in Texas and not far from Texas, Florida, etc. A lot of fast-growing companies down there in the climate space, as an example. Obviously beneficial in terms of sun as well. So that's good, but yeah, that's why there's a lot of activity there.
Yeah, when you think about that generation, that supply chain that we've mapped out right from the first piece of electricity all the way through to the ChatGPT, a lot of that exposure is companies based down in that region, from generation to EPC contracting to equipment, technical manufacturing, all that sort of stuff. So it's a great place to invest at the moment.
Yeah, if a Texan company tell you they're going to ship this and to this customer, it's actually going to get done. If a Californian company tell you, you're like, yeah, right. Your workforce will block it. You'll get stopped somewhere. Like, good luck with that. So yeah, we love companies with headquarter addresses in Texas.
My question is about the shift towards passive management away from active management that you've seen so much moving towards quantitative and similar structures. How is that changing what you do, or is it impacting you? When we look at a lot of companies, they all own the same stocks. There's huge concentration just in a handful of very, very big companies these days. Is that something which you think is endurable, or does that give you opportunity outside of that area? Thank you.
Look, it's a great question. So the actual stats are more than half the market is now indexed, effectively. And then a lot of that is, particularly our super funds in Australia, they get pushed towards quantitative or enhanced quant. because they can't fall too far away from the index. Even though we're performing well, some of our peers are performing well, and that actually scares people off active management, and I can completely see that. I think from our point of view, we're very lucky that we basically focus on earnings growth quite closely. So we're not pigeonholed to sort of high quality, if that makes sense, or we're not pigeonholed to high ROE companies. We're basically just focused on earnings growth. And thankfully, that's sort of what a lot of these quant models work for as well. And so our process is working well because we're prepared to go to find the earnings growth into other industries. And we talked a lot about industrial industries today. A lot of our peers won't do that. As we go through this platform shift, the reason why we launched the Climate Leaders Fund and the reason why we launched the SMID Fund was not because we thought they would sell well. We launched them because we wanted to force the team to go look for differentiated sources of alpha, particularly in climate and particularly in small and mid-cap fund, because we too noticed, ultimately the fund was just big cap tech. And we didn't want a fund that was big cap tech because ultimately that's what the index can do for you. So by forcing the team into climate, we found all these great climate ideas, which happened to intersect with the AI ideas. The reality is those big spenders I talked about also have the strictest net zero targets in the world. So they've effectively supercharged the climate agenda. They're not doing this with coal, and they're not going to. And then the same idea with SMID was to bring Chow on board and launch the SMID fund to force the team down there. And so that's where we're getting our alpha from. That's why we're outperforming the index. But the trend you're talking about is probably going to continue. AI is probably going to make it worse. Ultimately, it suits our process. And so what we've got to do is just get on a plane, fly to Houston, I'm going to Taiwan on Sunday, fly to these places, look at the back of the rack and work out what's going to happen before the earnings move. Because the quant will follow it after the earnings move. Our job is to find it first, if that makes sense. And so, there's 3 ways to make money in the world. You can be smarter, you can cheat, or you can just be first. And sometimes it's easier to be first. That's sort of how we think about it. I don't know if you want to add to that.
Maybe just the one thing to add is right now we do see, because of the platform change, you are having reshuffling of the order. So, we're looking at, even Magnificent Seven, that every single big cap fund and every single index fund probably owning heavyweight, we think maybe only half of them would actually come out as real winners at the end of it. So you do see a really big rearrangement of the ranking order of the companies. No one has seen the memory companies, 2 of them entering $1 trillion market cap range. None of these are not big index stocks. So we do see when you have this big platform change, if you are on the right side of the platform change, you do find tomorrow's big heavyweight and index, tomorrow's winner earlier, and this is how you create alpha. And small mid-cap is a live example. So, just an interesting stat. So we want to keep this fund true to label to all of you. So we have a commitment. Whenever a stock gets sold out of the MSCI small mid-cap index and included in the MSCI large cap index, then we are committed to selling the stock out of our fund. We run a concentrated portfolio of 35 to 40 stocks. Over the 12 months, guess how many stocks gets taken away from me? Nick can keep it, but they get taken away from me. 10. So this is really sort of, that reshuffling of the deck chairs in action. These 10 stocks get taken out of small mid-cap index, become part of the large cap index, and then we end up capturing, a significant part of the return because we were basically early on the journey with them.
Just have another question over here.
Yep.
Hi. Is robotics a separate area of interest in your investment? And secondly, are you concerned about how AI is affecting the economy and the economy in turn affecting the share market?
Okay, so robotics it's an area called intelligent industry. We've looked at it for a long period of time. We have a couple of investments there at the moment. They're not quite in the top 10 or top 8, sorry. And this is one of the reasons why I'm going to Taiwan on Sunday, to go and look at all this stuff. We're going up, it's Computex in Taiwan. Jensen Wong's going to be there doing a big pitch. It's all going to be about physical AI. There's a big room and you cruise around some booths and look at some things. In terms of robotics, we do think vision is the one thing that every robot's going to need. So companies like Keyence and Cognex are the ones that we own there today. We'd love to find some more. It's trying to find that shovel in the robotics revolution, if that makes sense, is what we're looking for here. And obviously semiconductors and batteries, by the way, which we are already invested in, are the shovels in the robotics revolution. That's that one. On the economy, look, I mean, I'm sure we're going to get the AR questions, so I may as well do it now. From my point of view, yeah, just go back to the last platform shift. When the internet came along or when mobile came along, look, it was scary. This one's equally as scary for people because it's going a bit faster. But these things happen. If it was 60 years ago, we'd all be in the farm. We'd all be in the field planting crops. Along came the Industrial Revolution, along came tractors. Someone left driving the tractors and the rest of us became what we called intelligence workers or knowledge workers. Knowledge workers are probably going to go down and we're probably all going to become social media influencers or personal trainers or nutritionists. I mean, none of these industries existed 10 years ago. Social media influencers didn't exist before social media. Something will come along that'll do AI. So I'm reasonably confident that this will be the same, but it is going faster than anything we've seen before. And so that's always the hard bit as to how quickly you can do it. Last thing I'll just say is, look, people ask me this all the time, does that mean it's going to stop? The answer is no, because this has become geopolitical now. It's the US versus China, us versus the rest of the world. Every boardroom in Australia right now, every boardroom in the world right now is trying to work out how quickly they can adopt AI to either save money, improve the customer experience, or beat their competitor. And if they don't, their competitor's going to. And every country is having exactly the same conversation. And so that gives us a lot of confidence that you're actually just at the start of this. And there are things that can stop it, but they're probably low probability things from here. The back there, sir.
I noticed that you have CATL, which is a Chinese company. Could you talk us through the reasons why you chose that particular company? Because I do remember some years ago you weren't terribly keen on Chinese companies, so I was interested to see that it was included. Thank you.
So China, we do own CATL. It is our only Chinese company today. We also have we have looked at things like Wuxi Biologics before. If your job is to find the best 20 to 40 growth companies in the world, the reality is a couple of them are going to be in China. They just are. We tried investing in batteries outside of China. We bought Samsung STI, and it got beaten by the Chinese. James showed the market share slide before. Samsung STI is one of those lines going down, losing all of its market share, and thankfully got stopped out of the fund before we lost all our money on it. And on the flip side, they kept getting beaten by the Chinese because they have better technology and they have less warranties, less stocks coming back. And so from our point of view, we want to own batteries. There's basically 6 companies in the world and there's one that's clearly the best. CATL is the TSMC of batteries. And when they did an IPO in Hong Kong, which they did, so they moved off the A-share market to the Hong Kong, we decided to participate in that. And just to be clear, this is now the largest position in our fund. In fact, so mathematically, this is the best idea we have today. It's still only a 6% position, and it is our only Chinese stock. It obviously comes with the corporate governance risks, but that's nicely reflected in the really low multiple that we have to pay for it. It only trades at 22 times earnings today. So we think that's a risk worth taking, and that's what basically got us back to China.
Another question.
Yeah, it was the same question actually.
Okay.
Yeah, similar question, just how you assess the sovereign risk with investments into China.
Yeah, so the sovereign risk, the quality score that we have there for the company is actually versus the market multiple. And so if the quality score is, say, NVIDIA's, say, 70%, or in this case it's 87%, that's the premium we can pay above the market multiple. And so in the US, we compare that to the US market multiple, which is 20 times earnings today, which means we can pay 26 times earnings for NVIDIA. That's what we're happy to pay based on the quality of NVIDIA. This is compared to the Chinese market. The Chinese market actually only trades at 12 times earnings today, reflecting the sovereign risk you're talking about. And so we're prepared to pay roughly 22 times earnings for CATL. It currently trades at 24. The earnings are going to double in the next 5 years because it's growing at 30% per annum. In fact, the whole industry is growing at 30% per annum. Cattle's actually growing even faster than that. So provided they hold their margins, the earnings are going to double every 3 years. And if the multiple stays at 22 times earnings, we should double our money. That's basically how we reflect the sovereign risk. And it basically brings it back to the market multiple. We do exactly the same thing with TSMC. And I'm trying to think what else we own outside of... Those are the main two that are not in developed markets today. But as I said, you know, if your job is to find... Our job is to be your global growth manager, find the best growth companies in the world. Batteries are clearly going to grow. That led us to China.
So look, we do have a history, like our previous firm also used to run an Asian fund, which Nick was a fund manager of as well. So we do have a history of sort of dealing with this. At Monroe, people may recall, the other question might be recalling that Alibaba was actually one of our biggest positions just prior to the Ant Financial IPO. The day that got pulled, we basically halved the position straight away. So to Nick's point about being first, good position for us. Tencent as well, we did the same thing, got rid of them pretty quickly because the government went pro big tech to negative big tech. At the moment, these companies, BYD, CATL, etc., they're on the positive side. Same with the solar companies as well.
Okay, if there are no further questions, Nick, before Taylor wraps up, have you got any final comments you wanted to make? Or?
Yeah, so we'll be available afterwards. Have a coffee if you've got more questions. But yeah, as I said in my earlier presentation, this is actually a very exciting time. This is the most engaged I've been in what we do in the whole 10 years we've been doing Munro. We are in a platform shift. Platform shift's going to create a whole bunch of new winners. We've got an amazing team running around finding these new winners, and that gives us a lot of opportunities to generate returns. And so it's a very exciting time to taking risk. The time to manage risk will come, I'm sure. And we have managed risk well in the previous difficult periods. There will be other difficult periods. We don't think this is one of them. We think you're at the start of a very exciting period, and it's a time for us to get on planes, go find good ideas and invest your money wisely. We really appreciate all your support, and we thank you for coming today, and I'll let Taylor just wrap up with some final comments.
Thank you. You did steal a few of my comments
Sorry.
there, but anyway. Fletch mentioned earlier, one of the best things about working at Monroe is being surrounded by really great minds, and I'm so thrilled today that you were able to hear our team speak live. We hope that you enjoyed the presentation and that it was helpful. Again, thank you for your ongoing support. Please make sure that you head to our website, sign up to our newsletter to keep up to date. We want to make sure that we're getting, all of the information across to you. As Nick said, the team are going to hang around if you do want to chat anymore, but otherwise that is it for today. Thank you so much for taking the time to come and spend time with our team today. Thank you.